Well, greetings and salutations, test takers. This is the Series 7 Guru coming to you from my off-grid studio, undisclosed location, off-grid, with another explication request. This is from an SIE test taker. Which of the following contracts do not have intrinsic value when the strike price is 40 and the market price is 30? So important, does not have intrinsic value. Intrinsic value has nothing to do with long or short. What it has to do with is the relationship of the market price 30 to the strike price of the option. So, this answer isn't dependent on whether you're long or short, is my point. Uh, Test takers do find it easier sometimes to take a long perspective to look at it, right? So what I mean by that is if we're looking at the strike price of 40 and it's a call, that would be a choice to buy at 40. Somebody else has an obligation to sell at 40 because, again, every contract has two parties. With the stock at 30, that makes no economic sense. It's not likely I'm going to exercise a 40 call when the stock is 30. If this is a 40 put, 30 in the long or short perspective, it doesn't have anything to do with the relationship. But if it's the long perspective, I have a choice to sell at 40. Stocks at 30. It is likely that contract's going to be exercised. Or from the short perspective, if I'm obligated to buy at 40, stocks at 30, I should be a little concerned. I think a good way to do this is turn it into a visual representation, right? There's the market price. Here's the strike price. As I said, we're asking about the relationship of 40 to 30, the strike price to the market price to the strike. Call up. We have memory aid devices for this. Call up. Call up is a memory aid device where market price is up from the strike price. If the market price is up from the strike price, the call contract has intrinsic value. Here, that's not the case. Call up, the market price is not up from the strike price. So if these are calls we're discussing, they were out of the money. They have no intrinsic value. There's no such thing as negative intrinsic value. You either have it or you don't. I'll link in a video description to two videos, call up, put down, right? Put down. If the market price is down from the strike price, if this is a 40 put and the strike is at 30, it does have intrinsic value. It's in the money. Those are synonymous terms. Now, this was an SIE test taker that asked for this explication. And I would tell you the SIE as it relates to options is mostly recognition. So I wouldn't worry too much about strategies as it relates to passing your SIE or this relationship. It is there. One question, maybe two. And if you're going on your 7, then it becomes a much, much bigger deal. All right, so that's the relationship we're discussing. Let's now look at the question. Which of the following contracts do not have intrinsic value? So as we said here, the call contracts do not have intrinsic value. A 40 put with stock at 30 has 10 points of intrinsic value. But this question, and that might have been the hang up too, these questions where they throw you the change up and are asking which do not have intrinsic value. The answer here is a 40 call with the stock at 30 has no intrinsic value. A 40 put with the stock at 30 does have intrinsic value. So if they said which of the following contracts do have intrinsic value, that choice would be D. B and C would be, nonsensical. I mean, that has nothing to do with this relationship of intrinsic value. Okay, well, I hope that was helpful. Remember, inch by inch, your exam's a cinch. Yard by yard, your exam is hard. And check out the video description, and I'll put both those videos call up and put down in the video description for you. Bye-bye.